Friends, thank you for being here today. What if I told you that the surest sign a building is about to collapse is when the engineers start removing the support beams? Yesterday, December 2nd, 2025, the Bank of England did exactly that. They announced they are lowering capital requirements for major banks for the first time since the 2008 financial crisis. They are calling it a measure to spur growth and support lending. But friends, you do not remove the airbags while driving at 100 miles per hour unless you have no other choice. You do not lower safety standards when a system is healthy. You do it when the patient is dying and you need to hide the symptoms long enough to avoid mass panic. This is not speculation. This is not theory. This is regulatory forbearance in real time, the same legal sleight of hand that regulators deployed in 2007, right before the edifice came down. They are changing the definition of safe because the banks can no longer meet the old definition of solvent. The crash is not coming, friends. The crash is already here. They are simply rewriting the rule book so you cannot see it. Let me give you a number that should create what I call cognitive overwhelm. £22.3 billion. That is how much new lending UK banks pumped into commercial real estate in just the first half of 2025. Not because these loans are good, not because the underlying assets are sound, but because the banks are desperately trying to extend and pretend to roll over loans that are about to default, to keep zombie corporations on life support for just one more quarter. And here is the forensic evidence that proves the rot is real. Debt funds operating in the UK real estate market are now seeing default rates of 20.3%, not 2%. Not 5%, 20.3%. That is not a correction, friends. That is a systemic heart attack already in progress. And the Bank of England's response: lower the capital requirements, release the pressure valve, allow the banks to hold less in reserves against the very loans that are failing. This is what I call the paper scaffolding. The UK economy is no longer supported by productive output, by factories, by innovation, by the things that create genuine wealth. It is supported entirely by credit expansion, by the creation of money from nothing, by a financial system that has become a Ponzi scheme dressed in the language of monetary policy. Here is the mathematical endgame they are trying to delay. The Bank of England has pushed back the implementation of Basel 3.1, the strict international safety rules that would force banks to mark their assets to reality from 2025 to January 1st, 2027. 2 more years of flying blind. 2 more years of pretending that loans backed by empty office buildings and failing retailers are worth par value. This is not a policy designed to create prosperity, friends. This is a policy designed to buy time. And time in a collapsing system is the most expensive commodity of all. The thesis here is not one of possibility. It is one of mathematical inevitability. When you lower the foundation while the weight on top keeps increasing, when you remove structural support while the building is already cracking, there is only one outcome. The only question is timing. The only variable is how many people will be inside when the structure gives way. Now, to understand why this moment is so critical, we need to go back to the genesis of the system itself. We need to understand how the United Kingdom transformed from an industrial powerhouse into what some economists now call a hedge fund with a flag. The pivotal moment was 1986, an event known in the City of London as the Big Bang. This was the deregulation that fundamentally restructured the British economy. It replaced manufacturing, replaced the production of actual goods with financial services. It turned the banking sector into the dominant engine of GDP growth. On paper, it looked brilliant. The City of London became one of the most powerful financial centres on earth. Billions flowed through its markets. The UK became synonymous with high finance, with sophisticated derivatives, with the kind of complex financial engineering that generates enormous fees and bonuses. But there is an economic theory that explains what actually happened, and it is called the finance curse. The concept is simple. When a country's financial sector grows too large relative to its productive economy, it does not add value, it extracts value, it cannibalizes the real economy. It drains capital and talent away from industries that make things, that build things, that create tangible wealth, and funnels them into speculation, into leverage, into the endless churning of paper assets that exist only on balance sheets. For 40 years, this model worked, or at least appeared to work, because the foundation was credit expansion. As long as banks could keep lending, as long as asset prices kept rising, as long as the music kept playing, the illusion could be sustained. But every Ponzi scheme has the same fatal flaw. It requires perpetual growth. It requires new money constantly flowing in to pay the old obligations. And when the flow stops, when the credit creation slows, the entire architecture begins to unwind. What the Bank of England did yesterday is the desperate final act of this 40-year experiment. They are sacrificing long-term stability to keep the City of London money machine spinning for just a little longer. They are allowing the banks to manufacture liquidity out of regulatory forbearance, because without it, the system would seize up immediately. Now, let me simplify the mechanism they are using, because this is crucial. The technical term is risk-weighted assets, but I want you to think of it as the magic scale. Here is how it works. If a bank lends £100 to a small business, to a bakery or a construction firm, the rules say they must hold £10 in capital reserves as a cushion, 10%. But if that same bank lends £100 to the government or to a so-called Tier 1 partner, the rules say they only need to hold zero, nothing. The loan is considered risk-free, even though we know that governments default, that sovereigns collapse, that nothing in this world is truly without risk. This is not a conspiracy. This is stated policy. It is written into the Basel Accords, into the international frameworks that govern banking. And what the Bank of England did by lowering the capital benchmark by 1 percentage point is to effectively release billions of pounds of required reserves back into the system. They are allowing banks to create new credit, new loans, new obligations, not backed by actual deposits, not backed by tangible collateral, but simply by regulatory permission. They are conjuring money from thin air to plug the holes in balance sheets that are already underwater. And here is the secret that they will not tell you, the part that reveals the true intent behind this move. The banks are not using this released capital to lend to you. They are not financing new businesses or building factories or funding innovation. They are using it to bail out what I call the zombie corporations, the massive entities that are so deeply in debt, so structurally broken, that their failure would trigger a cascade throughout the entire system. The name you need to know is Thames Water. This is the utility giant that supplies water to 15 million people across London and the Thames Valley. It is sitting on £20 billion of debt, 20 billion, and it is on the brink of what the UK government calls special administration, which is a polite term for nationalisation, for collapse, for the moment when the private creditors realize their bonds are worthless and the taxpayer is forced to absorb the losses. Thames Water is the UK's Lehman moment in slow motion. It is the canary in the coal mine, the proof that the rot has spread far beyond the banking sector and into the essential infrastructure that keeps the country functioning. And the regulators know this. The Bank of England knows this. That is why they lowered the capital requirements, not to spur growth, not to help small businesses, but to give the banks enough regulatory slack to keep the zombies alive, to keep the illusion intact for just a few more quarters. This leads us to the system's most crucial secret, which we will explore in greater depth as we move forward. But first, let me show you the other canaries, the other warning signs that are flashing red across every corner of the UK economy. Corporate insolvencies in 2025 are tracking near a 30-year high. Last year, 2023, saw 25,158 business failures. This year is on pace to match or exceed that number. The construction sector is being decimated. Hospitality is collapsing. These are not industries on the fringe. These are the sectors that employ millions, that generate the tax revenue the government desperately needs to service its own debt. And here is the really insidious part. In October 2025, the Bank of England launched a new regulatory regime called Strong and Simple. It sounds reassuring, does it not? Strong and simple. It is marketed as a way to make banking easier for smaller lenders, to reduce bureaucratic complexity. But when you read the actual policy, what it does is remove buffer requirements for smaller banks. It makes them more fragile, not more resilient. It reduces their ability to withstand a shock. And in a system where contagion spreads through interconnected liabilities, through the web of loans and derivatives that tie every institution together, making the smaller banks weaker, is like removing the fire breaks in a forest that is already smoldering. So we have the major banks operating with lower capital requirements. We have the smaller banks operating with reduced buffers. We have commercial real estate default rates at 20%. We have zombie corporations teetering on the edge. And we have a regulator that just admitted through its actions that it cannot enforce the old standards because the system cannot survive them. The liquidity tide is going out, friends, and we are about to find out who has been swimming naked. Now let me show you exactly what happens when you lower the safety rails while the train is already derailing. The trigger event occurred yesterday, December 2nd, 2025, when the Bank of England's Financial Policy Committee released its financial stability report. Buried in the technical language beneath the reassuring phrases about supporting growth and maintaining resilience was an admission that should terrify anyone paying attention. The report explicitly stated that the appropriate benchmark for Tier 1 capital requirements is now 1 percentage point lower than it was before. They moved it from 14% down to 13%, and they justified this by claiming the banking system is sufficiently well capitalized. But here is the contradiction that exposes the lie. You do not declare a system well capitalized and then immediately lower the standards. That is like a doctor saying your heart is perfectly healthy right before prescribing emergency medication. The two statements cannot both be true. What the report actually confirms is that the banks are sufficiently well capitalized only because the Bank of England changed the definition of capital and delayed the strict rules that would force honest accounting. This is not strength. This is regulatory capture. This is the moment when the referee admits he is working for one of the teams. And the timing is not coincidental. The Basel 3.1 framework, the international standard that would require banks to hold genuine loss absorbing capital against their trading books, against their derivatives exposure, against all the shadow positions they currently hide off balance sheet, was supposed to be implemented in 2025. It has now been pushed to January 1st, 2027. 2 full years of delay, 2 years where banks can continue to operate under rules designed for a different era, for a world where interest rates were zero and central banks were printing unlimited liquidity. But that world has vanished. Interest rates have risen. Liquidity has tightened. And the asset valuations that looked solid when money was free are now revealed as mirages. This 2-year gap is what I call the danger zone. It is the window where reality and regulation have completely diverged, where the marks on the bank's books bear no resemblance to what those assets would fetch in an actual market, and where the authorities are praying they can make it to 2027 before someone forces the reckoning. Let me give you the forensic evidence that proves the rot is already systemic. Thames Water is not an isolated case. It is the most visible symptom of a disease that has infected the entire infrastructure layer of the British economy. This company provides water to 15 million people. It is essential. It cannot be allowed to fail in the traditional sense because the taps cannot simply stop running. But it is sitting on £20 billion of debt that was loaded onto its balance sheet by private equity owners who extracted billions in dividends while underinvesting in pipes, in treatment facilities, in the actual physical infrastructure that delivers water. The debt is unsustainable. The company cannot service it at current interest rates. And the only reason it has not already collapsed into special administration is because the creditors and the regulators are engaged in an elaborate game of extend and pretend. They keep rolling over the loans. They keep granting forbearance. They keep pretending the debt is money good, because the alternative, admitting it is worthless, would trigger a cascade through the banking system that holds those bonds, through the pension funds that own those securities, through the entire chain of financial claims built on the assumption that essential utilities do not default. But defaults happen when the mathematics no longer work. And the mathematics of Thames Water stopped working months ago. This is the UK's Lehman moment, except it is happening in slow motion, in plain sight, with the full knowledge of the regulators who are powerless to stop it without bringing down the system they are supposed to protect. Now let me show you the second canary: commercial real estate. The office buildings, the shopping centers, the industrial warehouses that were financed with cheap debt during the era of zero interest rates. UK banks surged £22.3 billion of new lending into this sector in the first half of 2025 alone. Not because the assets are sound, not because the rents are rising, not because occupancy is improving, but because the old loans are coming due and the banks cannot afford to mark them as losses. So they refinance, they extend, they pretend. And the proof that this strategy is failing is in the default rates. Debt funds, the shadow banks that operate outside traditional regulation, are seeing default rates of 20.3% in commercial real estate. 1 in 5 loans is failing. And these are not subprime borrowers. These are not speculative ventures. These are the supposedly sophisticated investors, the institutional money, the funds that were marketed as safe alternatives to traditional banking. They are collapsing because the underlying assets, the buildings themselves, are worth far less than the loans against them. When an office building in Manchester or Birmingham was valued at £10 million in 2021, that valuation assumed occupancy rates of 90%, assumed rents would keep rising, assumed cheap refinancing would always be available. But occupancy is down, rents are falling, and refinancing at 7% interest instead of 2% means the cash flow no longer covers the debt service. The building is functionally insolvent. But as long as no one forces a sale, as long as the bank keeps the loan classified as performing, the loss does not have to be recognized. The building stays on the books at 10 million, even though the market would only pay 6. Multiply this across thousands of properties, across the entire commercial real estate sector, and you begin to understand why the Bank of England had to lower capital requirements. The banks are sitting on an ocean of assets that are marked at fantasy prices. If Basel 3.1 were implemented today, if the banks had to hold capital against the real risk in these portfolios, many of them would be revealed as insolvent immediately. So the regulators delay, they forbear, they change the rules. This is the exact playbook from 2007. I want to be very clear about this because the parallels are not approximate, they are precise. In the lead up to the 2008 crisis, regulators allowed banks to hold mortgage-backed securities at par value even as the underlying mortgages were defaulting. They allowed off-balance sheet vehicles to hide leverage. They allowed models that assumed housing prices could never fall nationally. And when the edifice finally collapsed, when Lehman filed for bankruptcy and the credit markets froze, the excuse was that no one could have seen it coming. But people did see it coming. The forensic evidence was everywhere for those willing to look, just as it is everywhere today. The difference is that in 2008, the crisis emerged from the housing market, from subprime mortgages, from securities so complex that even the people who created them did not fully understand the risk. This time, the crisis is simpler. It is about debt, sovereign debt, corporate debt, real estate debt, debt that was accumulated during 15 years of near zero interest rates and is now impossible to service in a world where money actually has a price. And the trap is already sprung. Let me show you why there is no escape if the Bank of England tightens the rules. If they enforce the capital standards that Basel 3.1 requires, Thames Water collapses immediately. Commercial real estate collapses. The zombie corporations collapse, and the banks that hold their debt get pulled down in the undertow. So tightening is not an option. But if the Bank of England loosens the rules, which is the current path, which is what they announced yesterday, then inflation returns, because loosening capital requirements means banks can create more credit. More credit means more money chasing the same goods. more money chasing the same goods means prices rise. And inflation is already running far hotter than the official statistics admit. Anyone who buys groceries, who pays energy bills, who tries to afford housing, knows that the cost of living is suffocating. The official inflation rate might say 2 or 3%, but the lived experience of ordinary people is closer to 10 or 15% for the essentials. And here is the data that proves the UK economy is operating on fumes. British industry already pays 63% more for electricity than France. 63%. You cannot compete globally when your energy costs are that much higher. You cannot grow your way out of debt when the productive base of your economy is being suffocated by structural costs that your competitors do not bear. France generates most of its electricity from nuclear power. It is cheap. It is reliable. The UK decommissioned its industrial base and turned itself into a financial services hub that now cannot afford to keep the lights on. This is the finance curse in action. The banking sector grew so large, sucked up so much capital and talent, that the real economy withered. And now, when the financial sector itself is in crisis, there is nothing underneath to catch the fall. No manufacturing to pivot to. No energy independence to fall back on. Just a services economy built on credit and real estate speculation, both of which are now imploding. Let me give you one more canary. One more piece of forensic evidence that the insiders are already heading for the exits. 16,500 millionaires are projected to flee the UK in 2025 alone, not in a decade, in 1 year, taking £91.8 billion with them. This is capital flight on a scale not seen since the 1970s, since the last time Britain was on the brink of economic collapse and had to go hat in hand to the International Monetary Fund for a bailout. The wealthy do not leave because of taxes alone. They leave when they lose confidence in the system, when they believe the social contract is breaking, when they see the writing on the wall that everyone else is still pretending not to read. And what they see is a government with a tax burden at 38% of GDP, the highest since World War II, extracting every possible pound from the private sector to fund public spending that produces no growth, no productivity, no return. The UK is trapped in a doom loop. High taxes suppress growth. Low growth reduces tax revenue. Lower revenue forces either more borrowing or more taxes. More borrowing increases the debt service costs. Higher debt service costs require more taxes, and the cycle continues until something breaks, until the bond market, what I call the vigilantes, decide they will no longer fund UK government debt at reasonable rates, until the yield on gilt spikes and the government faces the choice between austerity that triggers riots or money printing that triggers hyperinflation. This is the encirclement. This is the moment where every exit is blocked. You cannot tighten without collapse. You cannot loosen without inflation. You cannot tax your way out because the productive class is leaving. You cannot borrow your way out because the debt is already unsustainable. And you cannot grow your way out because you have structurally crippled the industries that create real wealth. The Bank of England's decision yesterday was not a policy choice. It was a surrender. It was the admission that they have lost control, that they are now simply managing the decline, buying time with regulatory gimmicks while hoping for a miracle that is not coming. The crisis is not theoretical. It is not scheduled for some distant future. It is unfolding right now in real time, hidden beneath the surface of official statistics and reassuring press releases. And the most dangerous part is the normalcy bias, the human instinct to believe that tomorrow will look like yesterday. People see the same buildings standing, the same shops open, the same routines continuing, and they assume the foundation is solid. But foundations do not announce their failure with advance notice. They fail suddenly. The cracks propagate invisibly until the moment of collapse, and then everything that seemed permanent reveals itself as fragile. Friends, we are now facing what I call the convergence. This is not one crisis. This is three distinct structural forces hitting simultaneously, each one capable of breaking the system on its own, but together creating a trifecta that makes collapse mathematically inevitable. The first force is capital flight. We already discussed the 16,500 millionaires leaving the UK this year, taking £91.8 billion with them. But let me explain why this matters beyond the raw numbers. When wealthy individuals leave, they do not just take their bank accounts. They take their businesses, their investment capital, their networks, their expertise. They take the engine of job creation. A single millionaire entrepreneur might employ 50 people, 100 people, 200 people. When that person relocates to Dubai or Singapore or Monaco, those jobs disappear, that tax revenue disappears, that economic activity disappears, and it creates a vicious cycle. As more people leave, the tax burden on those who remain increases. The government still needs the same revenue, but now it must extract it from a smaller base. So taxes go up, which causes more people to leave, which requires higher taxes on an even smaller base. This is not a sustainable trajectory. This is a death spiral, and the Bank of England knows it. That is why they are desperately trying to keep credit flowing, to keep asset prices inflated, to maintain the illusion of prosperity long enough that perhaps the exodus will slow, perhaps confidence will return. But confidence is not returning. The data proves it. Poland, a country that was behind the Iron Curtain 40 years ago, a country that started its economic transformation from a position of devastation, is now on track to overtake the UK in GDP per capita within a decade. Not because Poland discovered oil, not because they have superior natural resources, but because they focused on building productive industries while the UK focused on financialization. They made things, they exported things, they created genuine wealth instead of shuffling paper assets between London bank accounts. The second force is fiscal suffocation. The UK government's tax take is now 38% of GDP. To put that in perspective, that is the highest level since World War II, since the era when the nation was rebuilding from rubble, when rationing was still in effect, when the entire economy was mobilized for existential survival. But Britain is not at war. Britain is not rebuilding from devastation. Britain is simply trying to maintain an unsustainable level of public spending while the productive economy beneath it contracts. And here is where the mathematics become brutal. When you extract 38% of GDP in taxes, you are not just taking money, you are taking oxygen from the private sector. You are removing the capital that businesses need to invest, to hire, to expand. You are making it impossible for entrepreneurs to start new ventures because the returns do not justify the risk when the government takes nearly 40% before you even account for regulatory costs, for compliance, for all the other frictions that come with operating in an overregulated economy. The result is stagnation. UK productivity growth is the lowest in the G7, the lowest. Britain is falling behind, not just relative to the United States or Germany, but relative to France, to Italy, to Canada, the country that invented the Industrial Revolution that once led the world in innovation is now becoming the sick man of Europe. And the government's response is to take more, to tax more, to regulate more, to do everything except address the structural problem, which is that the economy is built on a foundation of debt and financial services rather than production and export. The third force is regulatory capitulation. And this is the most insidious because it proves that the institutions designed to protect the system have been captured by the system itself. The Bank of England is supposed to be independent. It is supposed to act as a check on the banks, to enforce prudent standards, to prevent the kind of reckless leverage that creates systemic risk. But yesterday's decision reveals that the regulator is no longer policing the banks. The regulator is serving the banks. When you lower capital requirements, not because the risks have decreased, but because the banks cannot meet the existing requirements, you have inverted the entire purpose of regulation. You are changing the rules to fit the behavior rather than enforcing rules that constrain the behavior. And once that line is crossed, once the regulatory framework becomes negotiable, subject to political pressure and industry lobbying, the system loses its only safeguard against catastrophic risk. This is not speculation. This is documented fact. The Financial Policy Committee's report from December 2nd does not hide this. It states explicitly that the capital benchmark is being lowered to support lending, to support growth. But supporting growth is not the job of capital requirements. The job of capital requirements is to ensure that when growth stops, when the cycle turns, when defaults rise, the banks have enough cushion to absorb the losses without collapsing. By lowering that cushion in the middle of rising defaults, in the middle of a commercial real estate crisis, in the middle of a corporate insolvency wave, the Bank of England is not supporting growth. It is ensuring that when the crisis fully manifests, the banks will not have the capital to survive it. So we have capital fleeing the country. We have taxes suffocating the productive economy. And we have regulators who have surrendered their independence. Three forces converging, creating a pressure that the system cannot withstand. And the response from the authorities is to pretend everything is fine, to manage the optics, to buy time with accounting tricks and regulatory forbearance while the foundation crumbles beneath them. Now, let me talk about your mind, friends, because this is where the real battle is fought. The greatest threat you face is not external. It is not the Bank of England or Thames Water or commercial real estate defaults. The greatest threat is your own psychology, your own hardwired tendency to believe that tomorrow will look like yesterday. This is called normalcy bias. It is the cognitive trap that keeps people in burning buildings because they cannot accept that the fire is real. It keeps them standing on the deck of a sinking ship because they cannot believe the hull has been breached. Human beings are pattern recognition machines. We navigate the world by assuming that what happened yesterday will happen today, that what happened last month will happen next month. This assumption works beautifully in stable systems. It allows us to function without constant paranoia, but it fails catastrophically when the system itself is undergoing a phase change when the rules that govern the past no longer apply to the future. Right now, normalcy bias is telling you that the UK banking system is safe because it has always been safe, that your deposits are protected because they have always been protected, that the government will step in if things get bad because that is what governments do. And on the surface, nothing contradicts this. The banks are still open, the ATMs still work, your paycheck still arrives, the shelves in the grocery stores are still stocked. But beneath the surface, the scaffolding is failing, the supports are buckling, and by the time the visible signs appear, by the time the bank queues form, or the currency collapses, or the bond market seizes, it will be too late to act. The exits will be jammed, capital controls will be in place, and your wealth, your savings, your financial security will be trapped inside a system that is imploding. This is why I call it the money illusion. You look at your bank statement and see numbers. You see a balance that might be growing, that might be keeping pace with nominal inflation, and you feel secure. But those numbers are denominated in pounds sterling. They are claims on a currency that is being debased, that is losing purchasing power, that is backed by a government drowning in unpayable debt and a banking system held together by regulatory duct tape. Let me make this concrete. Imagine you have £100,000 in a UK bank account. In 2020, that might have bought you a decent flat outside London, a reliable car, a year of comfortable living. Today, that same £100,000 buys you significantly less, not because the number changed, but because the value of the pound changed. The purchasing power eroded. And if you price that £100,000 not in nominal terms, but in real terms, in terms of gold or energy or productive assets, you will see that you have gotten poorer, even though your bank balance stayed flat. This is the wealth illusion that the authorities are counting on. They are counting on you to focus on the nominal number, on the digits in your account, rather than on what those digits can actually purchase. They are counting on you to believe that inflation is transitory, that rates will come down, that everything will return to normal, because as long as you believe that, you will leave your capital inside the system. You will not demand physical gold. You will not move money offshore. You will not take the actions that would expose the system's fragility. But friends, the window for preparation is closing, not in some distant future, not when the headlines scream crisis, but right now, while the system still functions, while capital can still move, while you still have options. And this brings us to the binary choice, the decision that will determine whether you emerge from this crisis with your wealth intact, or whether you become another casualty of a system that privatized the gains and is now socializing the losses. The choice is simple. Do you own assets or do you own claims on assets? Let me explain the difference because it is everything. When you hold stocks, you own a claim. You own a piece of paper that says you have equity in a company, but that paper is held in a brokerage account, which is held in a bank, which is subject to the regulatory framework we have been discussing. If the system freezes, if capital controls are imposed, if the government decides to impose a windfall tax or a wealth levy, your claim can be restricted, can be taxed, can be diluted. When you hold bonds, you own a claim on future payment. You are trusting that the borrower will have the currency to repay you and that the currency will still have value when repayment occurs. UK government gilts are promises to pay pounds. But if pounds are being devalued through inflation or currency crisis, you are being repaid in depreciating paper. When you hold cash in a bank account, you own a claim on the bank. You are an unsecured creditor. If the bank fails, you are relying on deposit insurance, which in the UK covers £85,000 per institution. Anything above that is at risk. And even the insured portion is only as good as the government's ability to honor it, which brings us back to the fiscal suffocation problem we already discussed. But when you hold physical gold, when you hold silver, when you hold bearer assets that exist outside the banking system, you own the asset itself, not a claim, not a promise, not a digital entry in a database, the actual thing. Gold does not have counterparty risk. It does not depend on a government solvency or a bank's capital ratio or a regulator's forbearance. It exists. It has existed for 5,000 years as money, and it will continue to exist regardless of what happens to sterling or the Bank of England or the UK government's credit rating. This is not about speculation. This is not about trying to get rich. This is about stepping out of the line of fire. It is about recognizing that we are living through a currency crisis in slow motion, a sovereign debt crisis that has not yet reached its acute phase but is mathematically unavoidable. And the choice is whether you want your wealth denominated in claims on a failing system or in assets that have no systemic dependency. I know what some of you are thinking. You are thinking that this sounds extreme, that gold is for doomsday preppers, that surely the government will not let things get that bad. But friends, the government does not control this. The Bank of England does not control this. They are riding a wave that is far larger than their policy tools. They can delay, they can manipulate, they can change definitions and move goalposts, but they cannot repeal mathematics. They cannot make unsustainable debt sustainable. They cannot create real growth through monetary gimmicks. And history is screaming the lesson at us if we are willing to listen. Every fiat currency in history has eventually failed. Every government that borrowed beyond its means has eventually defaulted, either explicitly through restructuring or implicitly through inflation. Every financial system built on excessive leverage has eventually collapsed. The UK is not special. The pound is not magic. The City of London is not immune to the laws of economics. The question is not whether a reckoning is coming. The question is what you will do with the time that remains. Will you wait for consensus? Will you wait until the newspapers are running headlines about bank runs and currency collapse? Because by then, friends, the gold dealers will be sold out, the borders will have capital controls, the government will have emergency powers, and your options will have evaporated. Or will you act now while it is still boring, while your friends and family think you are being paranoid, while the system still appears functional? History favors the prepared. It favors those who see the fault lines before the earthquake, who smell the smoke before the fire becomes visible, who understand that the time to board the lifeboats is not when the ship is vertical in the water, but when it is still level and everyone else is enjoying dinner in the dining room. The architects of this system are counting on your normalcy bias. They are counting on your faith in institutions. They are counting on you to believe that someone, somewhere, will fix this before it breaks. But no one is coming to fix it, friends. The people in charge are the same people who created the problem. The regulators who just lowered capital requirements are the same regulators who are supposed to prevent crises. The central bankers who are managing the decline are the same central bankers who inflated the bubble. You are on your own. Your family is on your own. And the decisions you make in the coming weeks and months will determine whether you navigate this crisis or become a casualty of it. Choose assets over claims. Choose tangible over digital. Choose independence over trust in a system that has already proven it will sacrifice your wealth to preserve its own structure. The edifice is cracking, friends. The scaffolding is failing, and the window for escape is closing in real time. I cannot tell you exactly when the collapse will manifest visibly. I cannot give you a date, but I can tell you that the process is already underway, that the mathematics are inexorable, and that preparation is not optional. History favors the prepared, and the window for preparation is closing. Thank you for being here today, friends. Thank you for being willing to see what others refuse to acknowledge. Now act accordingly.